An interesting time in markets. Obviously, the last 2 or 3 weeks has been significant moves in rates and yields, with rates rallying in the US particularly. What we've seen is that perhaps given the extent of economic data being slightly mixed, some good, some less positive, probably the rates move has gone too far too soon in a short space of time. And so what we've done is taken the action to look at reducing our fixed income overweight in portfolios for clients and gone back to a more neutral exposure in anticipation of when do we go back in should yields come more in line with our medium-term forecasts.
Right.
But the 10 years,
which begs the question then that, we've got, looking at the Jackson Hole, before that we've got the minutes, et cetera, and then further out that September meeting, et cetera. We're fully priced for 25, outside chance, 1 in 4 chance, we're going to get a 50 basis point cut. Which is it going to be, do you think? And more importantly, this fresh rate cut cycle, are we going to end up having 8, 9 cuts? Or what do you reckon?
I think that's what the market's trying to resolve for. Our own view is for 2 rate cuts this year, but there's some caveats. So today we're forecasting 25 basis points cut in September and another 25 basis cuts in the December meeting. Okay. So that's taking to 50 or to 2 for the year. However, much is going to depend on particularly the employment data. So if we think about what the Fed is solving for, there's the price stability or inflation, and then there's the full employment and the labor markets. And our sense is that they're comfortable with the inflation data coming back towards track, getting lower and lower. That seems to be, they're shifting their focus now into the labor market data. And we think the next non-farm payrolls print is going to be one of the most significant data releases before the first cut.
Do you see cracks in the labor market?
We can certainly see that it's beginning to be less positive than it was. One data print, I think, is very difficult to take away, because when you look at the standard deviation on the labor market data, for example, non-farm payrolls, it can be very wide, and there are a number of revisions to the data over time as well. Yeah, so we have to be mindful of how that's tracking.
There's going to be a monster revision coming up, I think, Wednesday stateside, right, by the BLS, Bureau of Labor Statistics, and that's going to go back for an entire year. It's likely to be revised down as much as by a million jobs, right? Which would mean that every single beat we've had in the last year becomes a miss. Is that priced in right now, or is that going to shock markets?
Well, I think from that perspective, that could shock the Fed, not just the markets, because the perception will be from the markets, how far behind the curve or ahead of the curve is the Fed ahead of the data? And they're trying to land this wonderful, immaculate landing, and our own view is that that's probably on track for now. But the data is mixed, as I said, and it's something to remain watchful for.